Good evening and welcome to the Money Show, your trusted destination for investor education, financial awareness, and smarter money decisions. In today's fast changing world, managing money is no longer optional, it's essential. From rising expenses and changing lifestyle to market volatility and digital investing, every individual today faces one important question: how do I make my money work smarter for my future? And that is exactly what this show is here to help you understand. Also, do get to get your mutual fund portfolio queries answered. Our experts will analyze your portfolio and will suggest you how can you churn your portfolio, which mutual fund is suitable for you, or which mutual fund you can exit. You can send your queries on number flashing on your screen, that is 865 797 4571. You can mail also your query. You can mail to the money show at etnow.tv. So in today's guest, I'm joined by a very special guest today, Nisreen Mamaji from MoneyWorks Financial Services. Thank you so much, Nisreen ma'am, for joining our show, The Money Show. And I'll start with our queries only. So first query is from Rajesh. So Rajesh Kumar from Uttarakhand, he has sent his query. He has written that I'm a retired professional with a mutual fund corpus. I am concerned about recent market volatility. I am unsure whether to shift money to FDs or continue with SWP. Also, I need liquidity for my son's marriage. Please guide me on the safer retirement income strategy. So, ma'am, this is a query of Rajesh Kumar from Uttarakhand. So, what will be your advice for Rajesh? Although he understands well about the SWP and liquidity management.
Sure. So, Rajesh, thank you for being on the show, and it's a very, very interesting query. And I think this also can be viewed and applied by many of our viewers. So, since you are retired, your first priority typically should be capital protection and not return maximization, because you're in that stage of life now where your accumulation period is over, and now you are in your deferment stage, or where you're actually going to be utilizing your saved corpus for your liquidity needs, as well as you have other goals as well. So you have your son's marriage, which could happen at any time, and that money should not be exposed to too much of volatility, which is the case in, say, equity markets. So my immediate recommendation would be to separate your corpus into various buckets. So now whatever you need for the next 2 to 3 years, that is for your own cash flow management as a retiree, should be invested into bank FDs, maybe liquid funds such as those by ICICI, HDFC, or Aditya Birla, and say money market funds either by Kotak or SBI. You can also invest in, say, equity savings funds with a very low component of equity allocation, such as ICICI Prudential Equity Savings Fund. Second bucket that you require is for your son's marriage. That also you mentioned is could happen at any time. So here you could invest in short duration debt funds, maybe ICICI or HDFC. Banking and PSU debt funds also is a good option for you. Maybe you can look at SBI, and you can continue some amount of your fixed deposits for this bucket. And your long-term retirement income, because you already retired, you could invest in, say, multi-asset funds like White Oak or Aditya Birla. You could invest in balanced advantage funds such as HDFC or Nippon. And also you can look at equity savings fund, HSBC or HDFC, which have a higher equity allocation than the one mentioned previously. So rather than investing the entire corpus into, one particular kind of a combination of FDs and, say, high quality debt funds, and also the dynamically managed asset allocation funds from where you can do your SWP. So the last, one that I mentioned to you, your long-term retirement income bucket, where you're invested in multi-asset funds, balance advantage funds, equity savings funds, those are the instruments from which you can do an SWP. Now, what happens here is that you can have a predictable cash flow. It will lead to reduced volatility and also protection against, sequence of return, which is a risk that you will face in the retirement phase. So by, following this bucket strategy, I think you are more likely to meet your goals without too many surprises. So all the best to you in your investment journey.
Debt fund, this is a suggestion for Rajesh. Ma'am, please help us understand our viewers about the money market fund. If
Right.
somebody want to invest in a money market fund, how can they start their investment journey in money market funds?
Okay, so money market fund is like any typical, mutual fund. The money, the coupons or the investments in a money market fund will be up to 1 year. So if your goals are during the year, if you need this for your cash flow management, like you mentioned, for, you need it for your immediate expenses, say 2 to 3 years, every year you need some money. You also want some reduced volatility or no volatility like in a money market fund. A money market fund is typically invested in, say, government securities, in short term, very short term corporate paper, CPs, CDs, and so on. So here, you don't have any kind of surprises and you don't have much volatility, any volatility of equity. Therefore, you can you can plan your cash flow and your expenses accordingly. So in essence, it's a mutual fund. And just as you would invest in any other mutual fund, you would invest in a money market mutual fund.
Okay. So moving on, our next query is from Ramesh. So Ramesh has written that I'm a senior citizen and long-term investor. I'm making monthly SIP investment in ITC hotels, KIMS and BEL. What are the future prospects of these companies? Can I continue my SIPs in these shares, or do you suggest any other shares in their place for SIP investment? Please advise. So, ma'am, this query is a little different because most of the queries we get
Right.
about the SIP in mutual fund, but this Ramesh is investing in stocks through SIP. So how different is stock SIP from mutual fund, and what would be your advice for Ramesh?
Sure. Since you are a senior citizen, Rameshji, typically, I would advise against building your retirement portfolio through an SIP into individual stocks. This is best left to a fund manager, a researcher, and an analyst as to what stocks that they would be recommending in a particular portfolio. Especially since you're a retiree, you should keep your stock portfolio, since you're already doing it, to about 20 to 30% of your exposure. And typically, the remaining amount should be in a diversified mutual fund, such as a flexi cap fund, a large and a mid cap fund. So this would reduce your company specific risk while still you can participate in a long term growth story. Also, since you might be using now your retirement corpus for withdrawals also. In that case, you should also be including a multi-asset fund or an equity saving or balance advantage kind of a category, which are the dynamically managed asset allocation funds, mutual funds for your cash flow management needs, because you'll have to meet your expenses on a regular basis, but the market volatility might deter those withdrawals on a timely basis for you to meet your cash flow management. So for that reason, since you are an experienced equity investor, you can definitely look at flexi cap and larger mid cap funds, but also look at keeping the volatility contained because of your cash flow requirements that will be happening during your retirement period, and especially since you are a senior citizen. So try to stay away from limited, have a limited direct exposure to equity. 20-30% is fine. But beyond that, definitely you should not be looking at, individual stocks to build a good portfolio and a sustainable portfolio. Thank you.
For senior citizens, it's not advisable uh, to invest in stocks, or stock SIPs are not advisable. Maximum investment should be only 20 to 30% of their overall portfolio into equities. So this is your advice, ma'am.
That's right. Exactly. That's what I said. Yeah.
Okay, so for senior citizens, ma'am is saying that maximum only up to 20 to 30% of your overall investment should be into equity only, or they can go for other balance advantage fund, multi-asset fund, flexi cap fund. So moving on, our next query is from Sunil. Sunil has written to us that I want to know your view on Trust Small Cap Fund, Helios Capital Flexi Cap, and White Oak Mid Cap Fund. Are these funds suitable for long term? Could these stocks also need help to build 7 crore in next 10 years? So these three funds Sunil is asking would be able to build his 7 crore fund in next 10 years, but he has not mentioned that how much he'll be investing every month.
Sure. So we can help him with that. So typically, Sunil, these are all good quality funds, honestly. But whether they help you to reach your 7 crore target depends much more on how much you invest rather than your fund selection. So I'll just do a quick portfolio review for you. Trust Small Cap Fund is suitable for investors with a high risk tolerance and a 10-year plus horizon. And Trust AMC itself is a newer AMC, which has been introduced in the markets. Helios FlexiCap Fund, it has a differentiated FlexiCap strategy and can be considered definitely for diversification. And as far as the White Oak Midcap Fund is, it's a quality midcap fund with a very disciplined investment approach. So the combination is giving you exposure towards flexi cap, small cap, and mid cap, which is quite appropriate for your long-term wealth creation strategy that you have set out to do. But whether 7 crores, in 10 years is quite a challenging, requirement that you have set out for yourself. And that depends very much on a substantial monthly SIP. So for example, in your case, if you're expecting a 12% compounded annualized growth rate, you are looking at an SIP of nearly 3 lakh rupees a month in the next 10 years. If you're starting with a lump sum amount, you're looking at starting with at least 3.6 crores, again at the same assumed rate of CAGR, which is about 12%. So this target is driven primarily by the investment amount, your expected returns, and the annual SIP that you have set out to do. Even if you go for a step-up SIP of 10%, you still will be, finding it very challenging. You'll have to start with about 2 lakh rupees and do a step-up SIP for the next 10 years. So if these figures matching your cash flow management and your investable surplus per month, then you can definitely go down this direction. But do remember that you have to review this funds and your portfolio very regularly to make sure that you meet your 7 crore target that you have made for yourself in the next 10 years. So, a little bit challenging, but of course, if the SIP figures are manageable by you, then you should be able to meet that. Keep a very, very close review whether your funds are performing and, make the necessary changes if required. But as far as the, the flexi cap, mid cap, and the small cap strategies go, I think they are well played out and you should continue the funds.
So for Sunil, advice is he want to make a 7 crore corpus after 10 years, then he should start a 3 lakh rupees SIP, and at the 12% CAGR in next 10 years, he'll be able to make a corpus of 7 crore. So now it's a time for a quick break. Don't go anywhere. We'll be right back after the break. Stay tuned. Welcome back after the break, and you're watching The Money Show, your daily guide to the world of personal finance. And I'm joined by a very special guest, Nisreen Mamaji. Ma'am, personal question. People keep asking me about someone who is starting his job recently, a 25-year-old who just started earning and want to start a SIP. So, and SIP of 10,000 rupees per month. So, what would be your suggestion to that person? How should he allocate that 10,000 rupees?
Sure. So that's a very good question, actually, because younger people, should get into the investing journey. And we talk to a lot of young people with their first paychecks who are about to start. So typically what happens is that, you have to answer one question. Do I want this money in the shorter term, or am I saving this, for my retirement, for my wealth creation? I'm not going to be able to, I don't need this money, say maybe in the next 2 to 3 years. So once you answer that, then you are also very clear as to this money is going to be aside and it's going to be for my retirement, for my wealth creation, maybe for a big asset purchase. Now, since you have time on your side, you're only 25, this is your first paycheck, you're only likely to increase your investable surpluses. I think you should be looking at certain higher risk. You can look at small cap funds, you can look at mid cap funds, you can look at thematic funds, but only if you're committed to investing for more than 7 to 10 years and keeping that funds aside, and you don't need it for your short-term liquidity. But if you're somebody who says, no, I might need this maybe in the next 1 or 2 years, I'm planning to go for a holiday, or I have some higher education that I want to do, I'm saving up for my fees, then it's better that you invest the funds into, say, maybe dynamically asset allocated funds. You can look at multi-asset funds, you can look at equity savings fund, you can look at the balance advantage category. So this is for, 1 to 3 years, because you might have a goal which you are going to meet in the next 1 to 3 years.
Okay,
So
ma'am. So,
depending
ma'am,
on the tenure,
next
you can
question
have
I
different
have
questions.
received from
Yes.
Arthur. I'll come back
Yeah.
again on this question because I have to take all
Sure.
the questions which we have received today. So, if time
Sure.
permits, I'll come back again. So, next question is of Arthur.
Sure.
He has returned to us. My daughter is 31. I want suggestions on her portfolio. She has Bandhan small cap fund in which she is investing 5,000 rupees per month. Then Motilal Oswal mid cap, again SIP of 5,000 rupees. Nippon large cap SIP of 5,000 rupees. And she has invested 2,25,000 rupees till now. Bandhan small cap, Motilal Oswal mid cap did not project good returns. So please advise if these need to be discontinued. What fund should be added to get a corpus of 50 lakh within next 5 years? So what would be your advice for Arthur?
Great. So, sure. So first of all, it's great to know that you find this show very informative and useful. And your daughter is 31 years old. She has age on her side, and she can take a reasonable amount of equity exposure for sure. So since you're investing in the small cap category, mid cap, and the large cap category, it's pretty interesting that whether you should continue or not. Now, whether you should sort of stop the SIPs because they're showing negative returns, that's obviously a no, because you only started the investments in November, say 2024, and since then the market has gone through a correction, particularly in the mid cap and in the small cap segments. So temporary negative returns over such a short period of time are completely normal. And there is no reason to, have any kind of a panic attack or stop your SIPs. In fact, during the market corrections, they are beneficial for the SIP investor because you are able to buy more units at a lower price. So an SIP investor is always benefited by the short-term market corrections, and in the longer term, your returns will be recovered. So it's in your favor that you are seeing a so-called sale. Should you replace any of these funds was your next question. So typically, your Nippon large cap fund is a very stable fund and it forms a very good core holding. Motilal Oswal mid cap fund has the potential to deliver strong long-term growth. Bandhan small cap fund is a little volatile. Obviously, it's a small cap fund, but it can significantly contribute to your wealth creation goal that you have for the longer term. So the portfolio is pretty diversified across the sectors, capitalizations of large cap, mid cap, and small cap. and therefore you could consider keeping it the way it is. Now, if you want the portfolio in the next 5 years to reach about 50 lakh rupees, here we can sort of tone down our expectations a little bit because you're investing a certain amount per month. You have an SIP of 15,000. You have a corpus of about 2.25 lakh rupees. So even if we consider, say, 12%, return of expected compounded annualized growth rate, after 5 years, your target corpus would be about 16 to 18 lakh and not 50 lakh, which you are expecting. So in order to achieve 50 lakhs in only 5 years, then you would, you have a couple of options. You can increase your SIPs to say 55 or 60,000 rupees a month, depending on, your returns that you get. Or you basically, what you should be looking at is extending your investment horizon. That would be a smarter way than rather than expecting such a huge corpus in only 5 years. So I think what you should be doing is, continue all the three SIPs. Every year, increase your SIPs by 10%, which is very manageable from an investor point of view. Don't discontinue the funds just because they are showing shorter than lesser than expected returns, because in the short term this is completely normal, and if your is a non-negotiable target,
Suggestion,
for
ma'am. Now, ma'am,
example,
we are left with
then
only
increase the
one more
amount.
minute. So, ma'am, that
Okay,
coming to my original question, just very
right.
short and crisp. So somebody starting with 10,000 rupees of investment journey, 25-year-old,
Sure.
next 20-year horizon. How much amount you will suggest to invest in different mutual funds? Short and crisp
So,
answer.
sure. So, as a mutual fund distributor, I would give you the greatest incidental advice of investing, say, 3,000 rupees in a multi-asset fund, which you can use after 2 years, and 7,000 rupees in a small cap and in a sector, which you will use for the later term. So, that's the short and crisp answer.
Thank you so much, ma'am, for your time and
Sure.
insights and taking all queries of our viewers. With this, it's a wrap on this edition of The Money Show. Stay tuned to ET Now. More on the other side.